First, India is emerging as the new growth engine for the world. In a highly volatile and uncertain world, India is standing out for its resilience and stability.
The Reserve Bank of India today announced an additional cash reserve ratio of 10% on incremental deposits that banks collected between the 19th of May to the 20th of July.
Well, the Monetary Policy Committee of the Reserve Bank of India left the repo rate unchanged at 6.5% and also retained its stance.
But it all depends on how much of the seasonal correction in food prices.
Central banks are usually worried about one massive thing: liquidity, or in simple terms, the amount of money moving around the bank system. Because if there is too much money lying within banks, there is a high possibility to lend it out too freely. Corporates could borrow and expand their business. People might take loans and spend, buy new vehicles or take vacation, shop more, etc. Demand for everything could shoot up, and you know what happens as a result of this, right? It can push the prices higher. We know it is an alarm for inflation. So if you ask, how does central government deal with this? Well, commonly they control inflation threat with the biggest tool at their disposal: the interest rates. See, banks have a leveler called the repo rate. This is the rate at which commercial banks can borrow money from the RBI. Now, if the RBI is worried about the inflation, it pushes the repo rate higher. The premise is that if it gets more expensive for a banks to borrow money when they need it, they will pass on the cost to the people who want to borrow from them too. Basically, borrowing gets expensive and demand drops. It can overcome the inflation, but that's only half the job done. Because liquidity could still be a problem. Banks may not necessarily pass along a higher borrowing cost initially if they are sitting on the stack of excess money. They might choose to keep lending at the lower rate, and that's where the something called reverse repo rate comes in. This is the rate at which banks can deposit money with the RBI, and in order to lure the bank into its depositing their excess money in its wallet, the RBI increase the reverse repo rate, and the RBI usually deploy these levelers together when they think inflation and liquidity could be a bit of an issue. Sounds simple enough, right? But we are just in the beginning of the issue we are facing today. We are actually in an exact environment where we have this exact problem, and we have three key reasons for it. Firstly, more people are borrowing money from the banks, which is growing quickly. Secondly, the prices for the things we buy are going up too fast, which make it difficult to manage the finance. The people who take care of money, government or RBI in our country, are trying to keep the prices from going up too much, but they are higher than what RBI or government want them to be. Right now, almost 7.50%, but they want it to be only around 4%. They say it's because the recent rise in the vegetable prices as well. And thirdly, banks have a lot of extra money, more than 2.5 lakh crores. This money is more than they need for a regular banking stuff and even for emergencies in banking. You might be wondering how this has happened. Well, there are a couple of reasons for it. Firstly, you remember when the 2000 notes were taken out of use a few months ago, almost 90% of those notes were put back into the banks. Even if some people took out different amounts of money, it seems like banks got more than 2.5 lakh crore than before. And the second reason is that the government started spending more money on things like roads and buildings. When the government spends money, it goes to the people who do the work, and they put some of it in the bank. That's why the bank have more money now. Like we said, it's the classical high liquidity plus high inflation problem. Now we understood the problem well. We are curious that how RBI tackles it. We wonder what the talks was like at the RBI headquarters during the meeting few weeks ago. Maybe something along the lines of why not rise the repo rate to make the borrowing cost more, and also increase the reverse repo rate to attract the banks into putting their cash with the RBI. Don't you think so? But reality was different. The RBI didn't take this forward. They kept the repo rate unchanged at 6.50%. Likewise, the reverse repo rate stayed at 3.35%. Everything remained the same.
Our banks remain healthiest in more than a decade, with historically high levels of capital. It has been decided that with effect from the fortnight beginning August 12, scheduled banks shall maintain, I repeat, scheduled banks shall maintain an incremental cash reserve ratio, that is ICRR, of 10% on the increase in their net demand and time liabilities, that is NDTL, between May 19th and July 28th.
But wait, why wouldn't they just raise the reverse repo rate instead? You might be wondering why banks wouldn't just put their extra money into the reverse repo if they had it. Well, it's like this. Even if the banks have more money than they need, they might choose to do something else with it. They could lend it to the people or invest it in a way that could help them make even more money. Now, here is an important rule that banks have to follow: the cash reverse ratio (CRR). This rule isn't optional, it's a bit like a school rule that everyone must obey. This rule directly affects the extra money in the entire system. So imagine if you have a big jar of marbles and the rule says you must keep a certain number of marbles locked away. If the new rules comes into the play, it means some marbles will be taken out of the jar and put away. If we use this idea with the new rules, around 1 lakh crore will be taken out of the entire system and given to the RBI, which is like the big banks that take care of all other banks. Additionally, if the RBI believes that the problem of having too much money in the system will go away soon, they might choose to use this method. It's kind of like if you have excess money in your account and you know you won't want that much money tomorrow, you might give some away to your friends today. But here is something interesting. There is another piece of puzzle that RBI didn't mention to us. It's like they gave us a problem to focus, and there is one missing piece that we need to find to complete the picture. That is the HDFC Limited merger with the HDFC Bank. Few weeks back, Deepak Shenoy, an investment manager, pointed out something quite interesting here. See, HDFC was not a bank. That meant it could raise the deposit, but it wasn't subject to CRR rule. But after the merger, suddenly all deposit could be clubbed within the banking system. The CRR would be applicable on the lakhs of crores of deposit that could come flooding in. Now the thing is that the bank also got a grace period of sorts. For 1 month after the merger, it didn't have to deposit the CRR of 4.5%. This basically meant that it could invest these massive deposits elsewhere and earn a nice chunk of money and pad up their profits. Now that doesn't seem fair, does it? So maybe by introducing this incremental CRR rule, RBI is simply trying to make up for the extra money HDFC might have made in that period. Maybe this has nothing to do with inflation or a liquidity really, and that was just a smokescreen. Well, that drags us to the end. We are not concluding that RBI making up the story, but we are bringing in the knowledge of what's happening around us in every rules and regulation coming into our system and cause and effect of it to be informed. Let us know what do you think as an individual about this. That's it, we have it for today. Thanks for watching. If you haven't subscribed to our channel yet, please consider subscribing. We'll see you in another video.